Ladies and gentlemen, welcome back to the channel. Tesla stock today was in the red. We actually had some good news. Canaccord Genuity raised their price target to $490 per share, said some very positive things about Tesla. We had very good numbers for vehicle insurance registrations out of China as well. But the stock was still negative because I think there's uncertainty about the government shutdown, whether we're going to shut down or not, or what kind of impact that will have. Now, in today's episode, we're really going to do three things. First and foremost, I have a clip from Morgan Stanley and why they think the government shutting down is not a negative catalyst for stocks, that stocks can largely just continue business as usual. Now, I will tell you, we're supposed to get a jobs report on Friday. We're not going to get a jobs report on Friday if the government is shut down. So it puts us in the dark a little bit in terms of the economy and economic data, let alone the economic impact a government shutdown could have. Okay. So that's number one. We're going to look at what Morgan Stanley says about a government shutdown. We're going to talk about a government shutdown, how that could impact markets, good, bad, historical aspects of that, of government shutting down. Okay. There's been 5 government shutdowns since 1990, and they actually tend to be a very positive event historically for markets. So we'll discuss that a little bit more in depth in this video. What we're also going to do is talk about Tesla's delivery numbers. Now, today is actually the last video where you're going to really be able to react to delivery numbers, okay? That's why I want to put the estimate out today, my estimate, which we do tend to be very accurate on this channel, and I want to discuss how, if I'm correct, how this delivery number could impact Tesla. Now, I say it's the last video before delivery numbers. It's technically not. Tomorrow, you will have the full trading day, but that video comes out at 4 p.m. So if you wanted to change your opinion based on maybe my opinion, which I don't recommend you do, but I know a lot of people do anyways, you'd only be able to react to Tesla in after hours tomorrow. And it just feels like a better way or time to get my opinion out there on delivery numbers. If you've been a viewer of this channel for a long time, you know that we are one of the most, if not the most accurate source for delivery numbers. Sometimes we've been within a couple hundred units of the actual number. It's honestly crazy how scary accurate we are when it comes to delivery numbers. Okay, so we're going to get into all of that. Okay. We're also leaving September seasonal weakness starting tomorrow. And that should maybe alleviate some of the just nervousness the algorithms have. So we have a lot of work to get into in today's episode. Hit that like button as well as subscribe to the channel if you have not done so already. Check out that link down below in the description of this video. If you want to come join the trading community, come get involved in some of the AI stocks that we're investing in, some of the small cap, under the radar kind of stocks, come join us. Okay, if you have not done so already. So, first and foremost, let's talk delivery numbers. Okay, so here's the deal when it comes to deliveries and Tesla. Deliveries are important for Tesla. They are becoming less important for Tesla. It's becoming more of an AI story for Tesla. Okay, but for now, delivery numbers are still very important. The Wall Street numbers, about 430,000, give or take. The stock, I think, is priced for about 450,000, give or take, because the stock is pricing in more than 430,000. I can pretty much tell you that. If Tesla gives us 430,000, the stock is going to likely trade lower on that. Although I don't think it's as big of a downward catalyst as maybe it was in prior quarters, right? I think people are kind of focusing on AI, robotaxi, Optimus coming next year, and new models, right? But there's that for you. And keep in mind, I'm not a financial advisor. If I didn't say that already, I'm not a financial planner. I could be wrong. There's a chance that my estimates are wrong. Okay. Keep that in mind. So that's kind of what the stock is pricing in. So anything above 450,000, I think, is positive. And then obviously the higher above that, the more positive it is. Anything below 450,000 likely has a negative reaction associated with it. Around 450,000, it's probably a neutral point-ish. And I would really say between like 445,000, 455,000 is kind of a neutral zone. That's kind of what is priced in. I wouldn't expect large upside or downside based on a number in those ranges. Okay, from 445 to 555,000, probably not going to get much of a positive or negative reaction, in my opinion. Now, here's the deal when it comes to deliveries. We don't get data out of the US. So the US is the biggest wild card. The US makes the difference in the delivery numbers. We get data out of China. We get about 60% of the data out of Europe. And we get data typically on the rest of the world. Canada tends to be pretty stable. So your main categories: China, USA, Canada, rest of the world, which includes like Australia, the Middle East, right? South America, Mexico, and then you have Europe. Okay, so from the insurance registration numbers, China in Q3 is at 165,350. Here's what's interesting. The US is usually below the China number. Usually. But this time around, it's not going to be. I'm estimating 190,000 deliveries in America. Now, with the tax credit and the pull forward in demand, this is the variable in what's going to give us a really good or really bad quarter. I don't want to say really bad. I don't think there's a chance of a really bad quarter. Like, that's not in the cards. But whether it's like in line with estimates or much better than estimates, it's all going to come down to America. I have the estimate at 190,000. It could be 220,000. Okay, it could be 30,000 higher than I'm estimating. And we'll get into that in just a moment. About 12,000 in Canada, 32,000 for the rest of the world. That number could be a little bit higher, maybe closer to 35,000 as well. And then Europe, solid 80,000. Okay. When you add these numbers together, you're looking at a total delivery number of 479,350. This is kind of the base case. So let's put that there. Base case. Okay. 479,350. Okay, that's base case. Now, a best case scenario, in my view, 165,350 plus around 220,000 deliveries in the USA. Canada, about 12,000, pretty consistent there. 10 to 12,000, but Q3 and Q4 tend to be closer to 12,000, but it's usually between 10 and 12,000. Plus, you could be at about 35,000 for the rest of the world, plus 80,000 for Europe, 512,350. That's more of a best case scenario. Anything above that, I would be really shocked. Like, I wouldn't be shocked if we hit, 510,000, 512,000. Like, that would be a really damn good number. Would I be shocked, though? Probably not. Okay. And then you have your worst case scenario, which this is like the lowest I think the numbers could come in. 165,350 plus maybe only 170,000 in America, plus 12,000 plus 32,000 plus 80,000. you're still at 459,350. I would view this as a slight positive. You would beat the estimates, but you're still pretty close to that neutral range. 445,000 again to 455,000. But it would be a slight positive. So even in my worst case estimates, you're still looking at a slight positive reaction likely in the stock. The base case, 479,350, likely gives you a 5-ish% upside in the stock. I would imagine, just, based on how long I've covered Tesla, a beat around 30,000 probably gives you about a 5% move higher in the stock. Best case scenario, above 500,000, around 512,000, could give you a 10+% move in the stock. So, hard to say exactly what ballpark we're going to fall in, but typically the base case scenario is the most likely. That is close to about 480,000 deliveries. If I were to guess, that's probably where we come in. But I wouldn't be shocked if there was some exceptional strength in the US. We get zero data for the US. So there's no way to calculate that. You just have to estimate. There's no way to accurately try to calculate that. Okay? And that's why estimates from different people and firms can vary so much. Because we get a lot of data for the rest of the world, Europe, China, but just not for the US. So the US is literally going to make or break these delivery numbers tomorrow. And I think it was probably better than most people expect. Okay, so we're going to keep these estimates here on this notepad sheet here to revise them if we do get new information tomorrow, perhaps. But these are the final estimates that I have. Now, from this current moment, a 5% upside in Tesla stock, if we come around that base case scenario, puts you at about $460 per share. 10% upside puts you at about $481, $482 per share. That likely gives you a test of new highs at about $488 per share. To get to new highs from here, to actually break them, say $489, you'd need a rally of a little over 11%. That could be in the cards with a delivery number over 500,000. Now, I also think Q4 is going to be pretty strong. I think there's going to be a pull forward effect of the tax credit expiring and the rules where you only have to put a down payment down. A good chunk of the deliveries are probably going to take place in October as well. October, early November, because of the tax credit. Okay, so I actually think Q4 is going to be stronger than Wall Street thinks. So I think Q4 delivery numbers are also going to come in much better than expected, which is going to be a positive catalyst, again, early 2026, January 2nd. Okay, so from a deliveries perspective, I'm not concerned at all. But there's again, always the chance I'm wrong, and you should ultimately come to your own conclusions. Whatever you think the delivery number is going to be. Let me know down below in the comment section. Now, a big wild card for tomorrow is, how does the government shutting down affect markets? Okay. There was some negative comments made today as well. Donald Trump, right now, when asked about the shutdown and government spending, said, "We don't want the U.S. government to shut down. Democrats are taking a risk. We can cut benefits. We can do things in a shutdown that are irreversible." And then Trump said a shutdown is not inevitable, but it is probably likely. Trump on spending says we're going to see what happens, expects government shutdown is likely, warns a shutdown could bring irreversible actions, and says Democrats are taking a risk. Notes benefits could be cut. Now, again, historically, the government shutting down is not a negative for stocks. In fact, typically the government shutting down, the S&P is actually up over 3% on average during a shutdown. 10-year treasury yields tend to drop over 10 basis points. Technology tends to do very well. And then once the government reopens, financials tend to do very well. It does tend to be a positive catalyst historically. Now, this time around, it seems like the economy's in a little bit more of an unpredictable state. It seems like the labor market has slowed down a little bit, and government shutting down can have a negative impact on the economy, right? Is it enough to cause a recession? I don't think so. Is it enough for people to get nervous about a recession? It could be. Another reason people are going to be a little bit nervous is we're not going to get the jobs report on Friday. And that just keeps investors in the dark. It keeps uncertainty high, and Wall Street does not like uncertainty. Okay? So it's really hard to say what will happen to stocks in the event the government does shut down. Now, that's why I want to share this clip with you. Morgan Stanley's Zizas says he's not too worried about a government shutdown from a market perspective. This clip's only about 3 minutes long, so take a listen.
Government shutdown. Let's bring in Morgan Stanley Global Head of Fixed Income Research and Public Policy Strategy, Michael Zizas. It's great to have you on a day like today.
Thanks for having me.
So what are you telling your clients? Because we don't see usually a big market impact from this.
Yeah, I mean, listen, I think it's pretty clear that the base case and the central case should be a shutdown. The vice president told you as much yesterday. The prediction markets have it as above a 75% probability. The reporting doesn't suggest there's a lot of movement happening, and there's a very substantive disagreement on these healthcare subsidies. So we should prepare for that to happen. The baseline is that, on average, your average shutdown is a few days, but there's a pretty wide range from a few hours to a few weeks. 35 days was what happened in Trump's first term. But the net market effects are pretty muted. So I think you probably shouldn't worry too much about it from a market perspective. There are probably some other policy principles to track that have some longer term impacts that are more meaningful. That said, the wrinkle here we all have to deal with is, are there going to be more substantive layoffs? And that's what the White House has been talking about. Those layoffs might not be all that consequential at the end of the day because they might end up being temporary. Courts might intervene, but that is a bit of a wild card here relative to recent history.
So potential for bigger layoffs hit to GDP?
Well, in theory, right? So your sort of baseline GDP impact from a shutdown per our economists would be about 0.1% per week. And that effect would fade over time as government employees come back to work, back pay is instituted. If there are layoffs and therefore there's permanent loss of jobs, then that's something that would be a bigger drag. So it's certainly a situation where this shutdown could feel different. But again, the pattern of behavior on government layoffs has been courts have intervened. A lot of them have been reinstituted. So I view this more as extra noise as opposed to something that fundamentally changes our outlook.
Still, sector-wise, it might be interesting, right? If airlines start feeling a hit, or if it's FEMA or some kind of economic assistance out of WIC, right? You'd be looking for wrinkles in there.
Yeah, and there's all sorts of disruptions and execution risks along the way. I mean, the 35-day shutdown in Trump's first term, that ended when there was a work stoppage, a travel stoppage at LaGuardia Airport because you had air traffic controllers who had called out. So if there are fears of that sort of going on for an extended period of time, of course that's going to have ripple effects. Ultimately, though, we think all of this is temporary. The more durable sort of tracking effects from policy in the near term are around higher tariffs, those costs having to be embedded into the economy, creating more growth risks, and then kind of longer out the debate about whether or not all the capex that we think is going to happen, is that going to lead us to sort of a better place from a growth
I was going to say, the House view at Morgan Stanley is pretty constructive, right?
Yeah, the equity view is pretty constructive. And I think there's a bit of a difference here between what we're expecting for equities and sort of what's going on in the broader economy, because a lot of these factors, the tariff costs, for example, are not well represented in the median earnings of the S&P 500. So there's a dynamic where growth can slow, but earnings can still do well, and so stocks can still do quite well.
So let me know your thoughts on all of this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. Have a great rest of your day, and I will see you in the next one.